Okay, welcome back. You're with us here on Editors Roundtable. Ajay Srivastava is joining us now. He's CEO of Dimensions Corporate Fin Services. Ajay, good to have you with us here as always.
Thank you.
You've been telling us two things. One, put money into debt schemes. They will outperform. And second, spend it has been your message the last few times that we've had you on the program. We've seen some pretty large changes on the debt side, especially if you were putting money into debt mutual funds. What's the call now, Ajay?
See, the call still remains that buy debt instrument, not necessarily just mutual fund, buy debentures, what you get NCDs in the market, you got to invest in all the your REITs that you get. Some of the REITs are very, very good investments. Debt remains definitely a great positive even today, because even if a AA rated debenture, you get about 11.5–12%. I think it's a great way. Even the government savings, your PF at 8.1%, absolutely fantastic. It's about 11.5% pre-tax. Now, that's not the yield you're going to compound on equities for a very long time. In the scenario that we are in, it can change overnight. It can do many things. But for the time being, I think your options remain more in terms of weighted towards buying long-dated debt paper, because this kind of interest lock-in, you may not get for very long. So rather than even mutual fund, I would say go direct investment, buy and lock in, buy in treasury. I don't know how many people are registered on the RBI portal. It's very easy. Believe me, it's very easy to buy even government treasury bills. It's quite simple, just a little bit of painful startup, but then you do it. So I would suggest more than mutual funds, you lock into a lot of the instrument as well. Mutual fund will give you one good capital gain ride in the next 2 years or so, but locking in instrument for interest bearing, I think, is a wiser way than invest in mutual funds.
Okay. Ajay, in the break you were telling us how perhaps this market could get worse before it gets better. Just trying to understand, because portfolios are already, bleeding at the moment. I mean, if you look at the mid-cap, small-cap end of trade, don't you think the worst perhaps is already in the price?
See, I do not know that. All I know, Sonia, is that the demand scenario globally is falling quite sharply. That's a new thing which we are seeing this time for the first time, and it is very visible. You saw the IT companies are seeing a great demand fall down, which is happening across the board. The pharma industry is seeing the pharma outsourcing. The biotech is into a absolutely a disastrous nosedive at this point in time in the US. And therefore, the big engine which used to generate revenues for a country like India, those are becoming much, much slower, and that's becoming more visible. Initially, we thought China plus one would come and dominate this theme. But what is really happening is that China plus one didn't really work out, because companies are still in China at this point of time. They couldn't get the efficiencies anywhere. Number two, the total demand is going down, and therefore there is no need to now move around or look for new vendors. So the whole China plus one thesis itself is a problem for India. It's not working out to the level it was supposed to, and certainly now it's fizzled out in most services industry. And as we're seeing more and more, the slowdown has just started. Physically now, stock price may run ahead of it or behind. I do not know the answer. I would still believe that there'll be a couple of big bad news in the corporate results in this year, as we see the demand falling for their services, old contracts falling off. The newer ones will not come into place at this point of time. And therefore, in terms of just the news flow, I think you'll be seeing a lot more negative news flows now onwards, because now we're really seeing the first big slowdown coming in the demand in the US at this point of time. It was never there for the last 6 to 8 months, but in the last 3 months, we are seeing a significant slowdown, whether it's IT, banking, pharma, biotech, pick up any sector. It's all across rampant now, and it's showing up now in customer orders.
Okay. Ajay, just on that point with regards to IT, yes, BFSI could be a pain point. Separately, we have tech disruptors such as ChatGPT and, artificial intelligence, which will probably pick up more pace going into next fiscal. FY23 IT is underperformed clearly. Do you think that kind of underperformance or the extent of underperformance will continue into FY24?
It's a difficult call, but I guess is that there will be a market performer, because they are sitting with an advantage of rupee dollar. At least the Indian companies are going to be market performers. The attrition levels have dropped, so the cost of people is going to drop quite appreciably. So you will find for the first time, I think IT companies' sales may drop, but the margins will go up in this year. And certainly for the larger companies, they enjoy more heft, and therefore they will see a bigger margin push upward north than the smaller IT companies. So, the big fallout of all this, attrition levels are down, people are sticking to the jobs, and the pay increases are now going to be much more normalized. So what I expect is that what they will lose in sales, they're going to make up in the margin in this year. So at worst case scenario, I think IT will still remain at par with market in this year because their margins are definitely going to expand even though the sales are falling, and they've done a good job of the management of people. But with the people cost falling and their leverage increasing, I think the margin will go up.
All right. Hi, Ajay. Ajay, tell us what about asset allocation? You know, fixed income, you have said that. But what if someone is allocating fresh money from now on? How much of it should go to fixed income? I mean, some portion could go to equities, right? And gold has been shining for the last, few months. It's at fresh all-time highs. What would your asset allocation be at this juncture, given the challenges, given the risk as well?
See, I think in pure asset allocation, one would definitely tend, as I said, that at least 40 to 50% you got to buy into fixed income and REIT products put together, because that's the two big one which will give you regular income. At least 40 to 50% minimum should go at that point of time. 20% should go to stocks with high dividend potential, which is the metal stocks in India, and go globally as well, no difference. There are 5-7 metal companies, they give phenomenal dividends. Ignore the chatter about promoter issues, ignore all the chatter, keep buying. They will give you so 20% you go for metals, 50% you go for various fixed income instruments. That's a 30% you go and start investing in equities. And in equities, the stories are very familiar. You can go for a good consumer name at this point of time. You can go for a good capital goods name. And I think between those two and the hotels being the biggest chunk of consumer, I would say hotel would be the number one pick. Even if you don't have it, buy it, because that's a longer story now emerging in India. So you'll pick consumer and you'll pick capital goods. And, defense at this point of time, PSU, if you're not in, wouldn't recommend buying for some time till you see a correction. But match a portfolio between a consumer and capital goods, and I think you'll be fine with your portfolio.
Okay, Ajay, I'm more interested in checking into a hotel than buying hotel stocks at this point, considering that there are so many holidays coming up, right?
Spend it. That's what Ajay
So Nigel, did you say how to spend the money? You saw Sonia. You kind of rates. I take away my salary in a day.
Ajay, it's happening naturally. The spending is happening naturally, and I've just come back from a vacation, so I'm following what you said. I went to Dubai, took the fam, and came. I stopped at all the duty free, had a good time.
And you know what?
Sonia's hometown. That is Sonia's hometown, isn't it?
Oh, I love that place. Don't get me started now. A lot of wanderlust happening. But you know what? Since it's Friday, Ajay, I thought you'll brighten up the mood a little bit. You're talking about the markets falling and, get into debt. You're not going to make any money in equities. You can cheer us up a little bit, right? What are your weekend plans?
I think we can cheer you up to say Delhi is enjoying some excellent weather. And the weekend plan is back to the tipplers, go back to the tipple. That's the end of the story. And, I'm not saying, please don't ignore. Okay, I'm not saying it's the end of the world has arisen and so on and so forth. But the challenge for most people is, they want to make money year on year. This is a year where the only way you can make money is you need to book your profits. That's the most important thing. Most people love the old concept saying, lakhe raho share ko, rakhe rahoge to bhaiya, wahi ka wahi, dunya goal hai, you land at the same place. That's a problem in the equity market today, that if you stay long enough in a stock, you make zero return. That's the problem in the market. And therefore, the paradigm is either spend, you have less angst. Debt, you are unglamorous. Equity, please sell when you book a profit. And if you fall in love with equity, that's the problem. The problem starts. So I'm cheerful, I'm nice, I'm happy. The only thing is, like every investor, you hate to part with the one which make money. Most of the times, you say, why am I selling this? But that's the paradigm. But cheer up, this thing sells too. Today was a good market. So what better way to spend the weekend?
Oh, yeah, absolutely. By the way, after Ajay having said all of that, his asset allocation is still 50-50. 50% debt, 50% equity. I got that right, Ajay?
Absolutely. 50-50. That's no doubt about it that, we will make our alpha eventually.
All right, Ajay. Thanks very much. Great speaking with you. Appreciate you joining us and enjoy that. What you will enjoy over the weekend. Well, that's it for the week.
Absolutely. And you folks have a great weekend. We'll see you again bright and early on Monday morning. Till then, stay safe.